For decades, the playbook for precious metals felt pretty straightforward, right? Gold was your ultimate safe haven, and silver was its trusty sidekick. But what if that entire playbook is being completely torn up and rewritten right before our very eyes?
Okay, let's just dive right into the deep end. We've all been taught that when things get chaotic, gold is the ultimate financial shelter. But lately, with its wild price swings, you gotta ask, is that even true anymore? Because the data right now is pointing to something new. And honestly, it's a little confusing.
So to really get to the bottom of this, we're going to look at the market from three totally different angles. First up, we're putting on our academic hats. We're going to see what the hard data says when economists dig into the market fundamentals over the last, say, 15 years.
Well, according to a recent economic study, the old rulebook for gold is pretty much broken. After sifting through more than a decade of data, these researchers found what they call a structural break right around 2017. And since then, the very things that used to drive gold's price, inflation, interest rates, they just don't seem to matter in the same way.
And this slide just lays it out perfectly. The old rule was so simple. Inflation goes up, investors pile into gold to protect their money, and the price of gold goes up too. Easy. But the new reality? It's the complete opposite. The researchers found that in this recent post-COVID era of super high inflation, gold prices have been flat or have even gone down.
So here's the kicker. If gold isn't acting like the classic safe haven, then what is? The paper points to a really surprising replacement, the US dollar. They noticed that during recent stock market downturns, it was actually the dollar that got stronger, not gold. The rules might literally be reversing. Okay, so let's switch gears to our second perspective. We're taking off the academic hat and putting on the institutional one, looking at this through the eyes of a major bank, JP Morgan. And we're also going to shift our focus from gold to its often overlooked companion, silver. I absolutely love this quote from JP Morgan's research team. It just perfectly nails how we all tend to think about silver. It's always Robin to gold's Batman. But as you're about to see, silver has its own really complex story, and it's driven by forces that barely even touch gold.
And here it is. This is the key difference. Unlike gold, which is mostly about jewelry and investment, a massive 60% of all silver demand comes from industrial applications. It's an incredible conductor, so it's essential for things like electronics, electric vehicles, even AI data centers. This makes its price behave in a totally unique way. And all that industrial demand, it leads to some pretty incredible volatility. Just look at JP Morgan's own forecasts. They had to jack up their 2026 outlook by a whopping 44% in just a few months. An adjustment that big shows you just how wild and unpredictable this market has really become.
So what's one of the biggest drivers of all this? The solar energy boom. Silver is a critical piece of solar panels, and as you can see, the demand from just that one sector has more than doubled in just a few years. It's been a huge factor in tightening the supply of physical silver. But here's the catch. It's a classic double-edged sword. Sky-high prices can actually destroy their own demand through something called thrifting. When silver gets too expensive, manufacturers get creative. They find ways to use less of it, or they find cheaper substitutes like copper. And JP Morgan warns this is a major long-term risk for silver.
All right, we've heard from the academics looking at the past and the institutions looking at industry. Now for our third and final perspective, the technical trader. This view, it throws out all the economic reports, all the industrial trends, and focuses on one thing and one thing only, the price chart itself.
This quote from Trader Garasullowy just sums up the mindset perfectly. For a technical analyst, the news, the fundamentals, it's all just noise that's already baked into the price. The only thing that tells the truth is the chart patterns, because they believe it's a pure reflection of human psychology, of raw fear and greed. So what are the charts saying right now? Well, Soloway points to this very specific warning sign that just showed up on silver's chart, a topping tail. Basically, it's a pattern where buyers try to push the price way up during the day, but then they fail and sellers come in and just slam it right back down. For a trader, that's a classic signal that a rally is losing steam.
And for a trader, it all comes down to probability. Based on patterns like that topping tail and what happened next, Soloway argues there's a 70 to 75% chance that silver's price is going to break below its key support level and head significantly lower. Now, it's not a guarantee, but for a trader, that's a very high probability setup.
So, where on earth does that leave us? We've got an academic view saying the old rules are broken, an institutional view of an industrial boom and bust, and a trader's chart screaming, "Watch out below." How can all of these things be true at the same time? Let's try to put it all together. This table really helps lay it out all. The academics look at economic history and they say, hey, the old rules for gold are broken. The institutions analyze industrial forces and see a super volatile and complex future for silver. And the traders, they're just looking at chart psychology and they see clear warning signs of a downturn. 3 different lenses, 3 very different conclusions.
So what's the right answer here? I mean, which one is correct? Well, the real takeaway might be that they all are. The precious metals market today isn't driven by one single, clean story. It's a messy, chaotic mix of all 3 of these forces churning at once. You've got broken economic models, you've got powerful real-world demand, and you've got raw human emotion playing out live on the charts.
And that brings us right back to where we started. We begin by asking if gold is still a safe haven. But after seeing how different experts are basically looking at completely different maps, all pointing in different directions, maybe the real question we should be asking ourselves is this: in a world this complex, what does a safe haven even mean anymore?